Welcome to this Killick Explains video, and welcome to another topical one, or at least I think so, which is this. Interest rates have undoubtedly risen far and fast recently, with a pause from the Bank of England as I make this video in October 2023. But here's the thing. Conventional wisdom says high interest rates are bad news for growth stocks. I want to argue that higher interest rates may not necessarily be automatically bad news for growth stocks. Certainly not all of them. Now, what is the conventional wisdom? Well, conventional wisdom is interest rates rise, growth stocks suffer, value stocks come into their own, defensive stocks if you like. But in the modern 2023 stock market, is that a sufficiently nuanced argument, or is it a bit of a blunt set of assumptions? Well, I might argue that the latter is the case. So first of all, why do people say interest rates rise, growth stocks, and I'll give some examples in a moment in case you're wondering who I'm talking about, will inevitably suffer, and they'll suffer good and hard? And the simple reason is people say, well, higher interest rates mean a higher discount rate. So when you're valuing a company, what you essentially do is you map what you think future cash flows will be, which is one big estimation. You put a terminal value on anything that's too difficult to predict year in, year out, and then you bring them all back to today's money, applying what's called a discount rate. You shrink the future cash flows, okay? And the further away those future cash flows, the more you shrink them to bring them back to today's money. And then you put it all together and say that's what the company's worth. It's very subjective, but that's the method. And here's the thing. People say, well, if that's the case, basically, if interest rates rise, you need to apply a higher discount rate to those future cash flows, which will make them smaller. And the problem with growth stocks is a lot of the value, a lot of the cash flow you're expecting comes further out. These are innovators and so on, market changes. So not only are you shrinking cash flows, but you're shrinking them aggressively, potentially, with a growth stock, more so than you would be with another type of stock, where the value you're expecting comes in a lot quicker, and therefore the discount effect is lower. So what people argue is the effect on immediate cash flows and what's called the terminal value is greater for a growth stock. But are we missing a trick? Because that might be true. I haven't said yet that's not true, but do growth stocks have something that other stocks don't? And that something is pricing power. Now we're going into a phase, okay, right now, autumn 2023, where this theory will be tested. But here's the point. If you're running the kind of business which is in demand, which is what's called sticky with consumers and so on, it might be you can outrun this problem. It might be you have pricing power that can beat inflation. And if that's the case, it changes the picture. It sort of mutes the impact of those higher discount rates. Why? Because what you're projecting in cash flows, all right, grows, and then you apply the higher discount rate, so one offsets the other. In other words, that sort of penalty for the fact that the cash flows are deferred with the growth stock may not be as great or even a factor. Now, what are examples? Okay, so I've said some growth stocks have this ability to hang on to customers and keep charging them even more money. Well, let's take some examples in these sort of groups. Microsoft and Apple. Now, I may be proven wrong on this, but Apple has weathered the economic storm reasonably well. Its products are sticky and command huge loyalty, okay? People want a titanium iPhone, even if the one they've got works perfectly well. Right? They want the new functionality. It's an exciting, sexy thing to own. It goes beyond what the lump of metal will do into kind of emotional commitment, attachment, brand loyalty, and so on. Now, I'm not saying you can't lose that, but it is a critical factor. Then you've got Meta and Google. I mean, their secret sauce, if you like, is massive advertising leverage. All right? They are able to command huge loyalty from advertisers with advertising revenue. All right? And whilst 10, 20 years ago, people would have gone, well, ad revenue online, that's the first thing to go from the corporate budget. These days, it's critical. The first thing to go is probably the other stuff, the physical advertising. So the world's changed there. NVIDIA, all right? Anybody telling the AI story right now without mentioning NVIDIA has got to be, smoking something, I think. Excuse the expression, but I mean, NVIDIA are at the heart of chip technology, AI development, and so on. And will probably stay there. Can't promise that. Amazon, Tesla. All right. Now, they're different companies. All right. One is a logistics company that sort of brings everything to your front door. The other is a car maker, but they dominate important niches. Now, question marks being asked, for example, about Tesla's dominance, given the march of the Chinese right now, but as a brand, pretty dominant in the global EV market and constantly innovating. And that's one of the things that binds some of these companies together. So, key investing questions from that brief tour. And by the way, those are not stock tips. All right, I'm not suggesting you rush out and buy them. I'm not suggesting my argument will necessarily hold, but I'm just saying the idea in your mind that these are companies that have what are called wide moats, the ability potentially to weather storms. So what are the key investing questions? Let's distill them down. I've got sort of 4 or 5. 1, if I'm looking at a growth stock that may not be hammered by rising interest rates, how much pricing power has it got? And pricing power is the ability to sort of navigate a headwind, if you like, by raising prices even at a time when inflation elsewhere might be coming down. To do that, you need what's called a wide moat. Warren Buffett, legendary US investor. A moat is an ability to protect the space you're in, keep competitors at bay, whether they're the little whippersnapper type competitors, the little innovators, or the big monster ones. All right? So you've got something about you which doesn't allow people to challenge your space easily. So look at EV manufacturers, for example. Now, the Chinese are coming over the hill, but if you look at European conventional manufacturers versus Tesla, Tesla's USP is the fact that Elon Musk went for the battery tech and the platform first, and then the chassis. The European car makers had no choice but to come at it the other way, and it's not looking too promising for them right now. Number 3, okay, so pricing power, size of a moat, customer leverage. What that means is, what sort of grip on your customers do you have? If customers are going to buy an iPhone, what are they going to buy? Now, there are other phones on the market, but are there reasons why people only want to buy Apple kit? And I'll suggest there probably are. 4, suppliers. What kind of grip does a company have over its supply chain? Can it keep costs down? Because obviously, making and selling something is making it and then selling it. So can they keep costs down? So in other words, the company might have pricing power as far as customers are concerned, but it needs pricing power the other side as well. Otherwise, the balance won't work. And how mature are its cash flows, and what's the correct discount rate? If you were to map future cash flows, what pattern do they follow? Is it true a lot of them come further out, are tied up in terminal value, or not? Now, that's a technical question, but it's one that analysts should ask. So overall, what you're thinking then is, if I see one of these big giants of the market sold off, here's the important and difficult question: is that the rational and right response from the rest of the market, or is it just habitual? They've got into the habit of saying interest rates go up, growth stocks need to be sold off, and therefore, is it correct? In other words, is the market acting in the way that it should, given the potential of some of these long-term names? Or to put it another way, do we need to be careful in 2023 with words like growth stock? Is that a bucket that covers a vast range of different styles of stock where you can't just go interest rates up, growth stock down? And within that, technology stocks. Because don't forget, an awful lot of old economy stocks are racing now to upgrade the offering to their customers. So the conventional view of a tech stock being very narrow and volatile and innovative has completely changed. And be careful just labeling things as tech stocks and going, well, clearly they will be sold off in this cycle. All right? I think you need a more stratified approach these days than that. Okay, lots of jargon in there. So Killick.com/learn, the shares tab probably is the best place to go for some more on some of the stuff I've been talking about in video form. If you'd like my How to Invest in Equities guide, then it's editor@Killick.com. If you'd like to read all about some of the names I've mentioned there, then Confidant is editor@Killick.com. And just to reiterate before I sign off, any of the names mentioned in this video are not tips. Okay, they are simply examples for the purposes of making educational content.